Mukul Kochhar from Investec Capital to discuss the market fundamentals, his top sectoral picks. Last time we spoke, Mukul, you did like the banking space a fair amount, and you did believe that maybe private capex was some time away. Where do you stand on right now? And also the weakness in the rupee, does that open some avenues for the export-facing names?
Yeah, thanks a lot for having me. See, let's just talk about the weakness in the rupee right now, because in the near term, and the U.S. trade treaty is a very important marker for that. Near term being, therefore, the next 1 to 2 months as we finalize the treaty. The rupee dynamics will be one of the strong sort of drivers of market performance. On the rupee side, absent of the U.S. Trade deal, the tariffs are quite high, which is discouraging trade with our largest trading partner. Therefore, we have gone into a current account deficit. Yeah. Now, a current account deficit at a time when FDI outflows are very strong, which means that the capital account is unable to support. Our capital account, the most stable driver of which is foreign direct investment, today is neutral, which by definition means our current account needs to be neutral. But because of the disruption caused by the US trade treaty, we estimate, absence of a trade treaty will be $60–70 billion current account negative. This is what is causing the pressure on the rupee, the balance of payment imbalance on a monthly basis, which the RBI is trying to manage, but honestly cannot manage for a long term, is the real dynamic today. Yeah. So that is the reality. I think it gets resolved if we get a reasonable trade treaty in place, but that is taking its own sweet time. Earlier we were hearing that it will be announced in November. Now, last few days it came out that it may get pushed to December. And given that these treaties are difficult to negotiate, there may be further delays. In the meantime, the RBI is managing the level of rupee, which honestly is a difficult task. Yeah. So this is going to be the prime center topic of discussion, I think, in markets till we get the trade treaty signed, and therefore will influence markets. On your question on,
yeah, go ahead.
Yeah, on your question on the private capex cycle, somewhat related. There is substantial ammunition and firepower with companies today for investment, and I will just give you one number on that. The difference between the capex of the BSE 500 companies and the profit they make today is roughly 7 trillion rupees. Yeah. Historically, this difference has been zero. Yeah. So historically, which means whatever profit the BSE 500 companies make, they invest back in the economy. But today, because profitability has been very strong post-COVID, the profit has gapped up, whereas capex is investing as much as it can, I feel, for the Indian economy without opening up a new market for the US. So while there is firepower available, while there is banking credit available, unless we add new market opportunities, I feel the private capex is going to grow at a nominal GDP pace 7 to 10%, because we are doing what we're doing. Import substitution is another 200 billion opportunity, but remember this gap, which is 7 trillion rupees, translates to roughly $80 billion. Even import substitution is not a big enough opportunity for this. Therefore, if we add US as a market through a trade treaty, substantial private capex, which is sitting on the sidelines, can come into play. And that is why last time we met, I said that till we sign the trade treaty, the private capex will also be anemic because there's no market to sell into. So these are the 2 points. Yeah.
Right. Mukul, so in that case, in anticipation of a potential trade treaty, would you believe that these export-oriented names which have US as a very major market, be it the textile names, be it the shrimp names, do you believe you should have some exposure to these kind of stocks? Considering the fact that they have been beaten down to that extent because of the tariffs and the resultant impact, do you believe that now, in case a deal happens, these will be the ones that would be the prime beneficiaries of that?
So almost, that's a fair trade, yeah. So probability based that we, if we get a treaty, the probability of that is high, yeah. The problem is that unfortunately, currency management has become a daily task. Yeah. So the probability that we get a trade treaty in some time frame is high. Therefore, for beaten down export names, I would say go and invest, because I'm also saying the probability of getting a treaty is high. The problem is the market is and the currency is fragile right now. So, and I don't know whether the currency can be managed for a period of 1-2 months, if and that is the time that takes to get the treaty. So we will get interim volatility. It is just something that investors should be aware of if they want to hedge and protect themselves against this volatility, that they can. But the probability that we get a trade treaty is high. For stocks that have corrected and probability based are good investments, absolutely go ahead and sort of buy those stocks.
Mukul, very quickly, running out of time, on the banking stocks, your view, especially in light of these comments coming in from the Ministry AOS Finance, to the Lok Sabha, that there is currently no proposal of merger of PSU banks on the table. This despite the Finance Minister, of course, earlier indicating that this is something the government is working on, but it looks like immediately it is not on the government's radar. How would you play the PSU stocks in that case?
So honestly, Ritu, the PSU banking space, I've generally found that to be very attractive over the last few years. Undeniably, they have their challenges. They have a social angle to them, given that they are government owned. But operations and policies regarding PSU banking space has improved substantially over the last 10 years. Yeah, they are very well capitalized. The NPAs are very well provided, 90 to 95%. Their cost of funding is as competitive as the private banks. Books are completely de-risked since they've been sort of just consolidating on their book for the last 5-6 years. I would contend that the books are in a better spot than a lot of private banks, and ROEs are 15%. In that context, I expect these stocks to re-rate further. Yeah. So in terms of returns, you will get the ROE return, which is return on equity of roughly 15%, and any re-rating that you may get. So this is an attractive space to invest. And the fact, if government is saying that there's no disruption that comes from mergers, should give investors some sort of comfort that they can just invest based on fundamentals, and government action is less of a less of a factor that they need to sort of account for when they invest.
All right, as we speak of the banks which are gaining right now, PSU banks form a fair amount of a chunk right now. If you look at the private sector banks, obviously they're buoyed down by the changes in the Nifty bank weightage. So we have the private bank index coming up for you at the lower end of today's trading session. And on the other side, if the PSU bank index comes up for you, you'd see the outperformance. The private bank index down about 1/3%. PSU bank index, that's about 0.8% higher. So if you put both of them together, it's about 1.2% sort of outperformance that the PSU bank index is showing. Thanks a lot for joining in, Mukul. With that, we'll take a short break, come back, focus more on the markets as we speak. The Nifty virtually at the low point of trade, down about 112 points.